Hello and welcome back to Debit Credit Done, the podcast that makes accounting simple, practical and totally passable. I'm your host, Dean Quartermain, and this is episode 8 of our second series on the AAT Level 3 unit, Financial Accounting, Preparing Financial Statements. So in episode 7 then, we combined the concepts of depreciation and disposals by working through a full cash disposal example, and then we twisted it a little bit with a part exchange example. So at the end of episode 7 then I set you a challenge, so let's just quickly review the solution to that before we move on to today's topic, which is control accounts. So the episode 7 challenge then, for those that remember, we had an asset that we'd purchased with a cost of £20,000, purchased on the 1st of January 20x1. Depreciation policy was straight line, 5 years, prorated in the year of acquisition and the year of disposal. Disposal was on 30th of September 20x3. The proceeds on disposal were £9,500. So remember, step 1, depreciation up to the date of disposal. So year 1 depreciation, straight line, 5 years, no residual value, £20,000 cost, 5 years straight line, £4,000 a year. So it's full year's depreciation in year 1, full year's depreciation in year 2, so 20x1, 20x2. And then in 20x3, we disposed of it at the end of September, so that's 9 months. Yeah, so 3/4 of a year's depreciation, so £3,000 for year 3. So overall, we've got £11,000 of accumulated depreciation to the date of disposal, and a carrying amount of the asset at the disposal date of £9,000. Step 2 then is all your disposal account entries. So we're going to debit disposals for the full cost of the initial cost of the asset, £20,000. So debit disposals, £20,000. Credit machinery, so a piece of machinery, £20,000. So that gets rid of the initial cost. The second thing is to clear out the accumulated depreciation related to that asset from the accumulated depreciation account. So we're going to debit accumulated depreciation, £11,000. Credit disposals for the same £11,000. And then the third step of the disposal entries is to record the disposal proceeds. So we're going to debit bank, £9,500, credit disposals, £9,500. Now got all our disposal account entries made, we then need to balance the disposals account. So you should see we've got debit entries of £20,000, credit entries of £20,500. So we've got a difference of £500. So we need to put £500 on the debit side of disposals. So that would lead to what's known as a profit on disposal. So the statement of profit or loss will show a £500 profit relating to that particular disposal, and the statement of financial position would end up having no trace of the old asset. So we removed all the entries related to that asset from the statement of financial position. So that's last episode's challenge. We're going to move on today to then look at control accounts. So by the end of today's episode, hopefully you're going to understand what a control account is and why businesses use them. Look at the structure of 2 key control accounts, the Receivables Ledger Control Account, sometimes abbreviated to the RLCA, and the Payables Ledger Control Account, which is abbreviated to PLCA. We're going to look at how transactions like payments, sales, discounts, irrecoverable debt, how they're posted to these various control accounts. We'll look at how we reconcile control accounts with the list of balances from the accounts, from the underlying accounts underneath the control accounts, and then look at the most common AAT traps and some tips for the exam around control accounts. So firstly then, what are control accounts? So control accounts are parts of the double entry bookkeeping system, and they act as a summary account for all transactions, in our particular case, all transactions relating to sales and purchases, so sales and purchase ledger accounts. So the Receivables Ledger Control Account, the RLCA, summarises what all the credit customers of our business owe us. So it ultimately represents the total of trade receivables. The Payables Ledger Control Account, or the PLCA, summarises what the business owes to its suppliers. So another way of saying that is it represents the total trade payables of the business. Now, these balances should always equal the sum of all individual customer or supplier accounts in what's known as the subsidiary ledgers. So that's why control accounts are essential for reconciliation, and it's really, really important that we reconcile between our control accounts and our subsidiary ledgers to understand whether there's any errors, whether there's any fraudulent transactions, whether there's anything being omitted from either the control accounts or the subsidiary ledgers. So let's look at the structure then of these control accounts. So there are many other control accounts. So one key one is a VAT control account. We're not touching on that today, but the concepts of control accounts is the same. It's the same concept. We're just looking specifically at receivables and payables in today's episode. So think of Receivables Ledger Control Account then as like a T account. Yeah. Let's bring everything back to a T account. So left-hand side, debits. Right-hand side, credits. Debit side of the Receivables Ledger Control Account, that increases what the customer owe to our business. Because if you think about what Receivables Ledger Control Account is in its entirety, it's a big asset. Receivables, money we're owed. Yeah, it's an asset to our business. So the debit, remember, back to your dead click. Yeah, debits. If it's an asset and you're increasing the value of the asset, you debit the asset. So we're going to so anything on the debit side of Receivables Ledger Control Account increases the value of the asset, increases what the customers owe to our business. So things that would appear on the debit side: credit sales, interest that we charge to the customers, any dishonoured checks, because obviously if you paid the check, that would reduce the value, wouldn't it? Credit side. If the check's then returned by the bank dishonoured, that needs to go back in because it's owed back to us. Credit side of the Receivables Ledger Control Account, that reduces what the customers owe us. So that would be things like any cash that we receive, any discounts that are allowed, any irrecoverable debt that's written off, any returns into our business. So if we sell something to someone and somebody sends it back to us, so as a return, that obviously we've now got the goods, they haven't got them, it reduces the amount they owe us. And the balance carried forward on a Receivables Ledger Control Account should be the total amount of receivables that are owed to our business. So it's the total of trade receivables. For a Payables Ledger Control Account, then it's the absolute reverse of that. So the credit side, so remember, Payables Ledger Control Account, it's payables, it's what we as a business owe to our suppliers. So if we're increasing the value of what we owe to our suppliers, what we owe is a liability. If we increase the value of that, we're going to credit the account. Yeah. So the credit side of Payables Ledger Control Account is where we're increasing what we owe to suppliers. So credit side would be things like credit purchases and any interest that's been charged by the suppliers. The debit side of Payables Ledger Control Account reduces what we as a business owe to our suppliers. So that's any payments we make, any discounts we receive from the suppliers, and any returns outwards, what's known as returns outwards. So outwards from our business back to the supplier, any returns reduces the size of the liability. And the balance carried forward on a Payables Ledger Control Account is the total of trade payables, the total amount we owe to our payables. So let's do a very quick worked example then. We'll look at a Receivables Ledger Control Account to start with. So the scenario we've got is an opening receivables balance of £10,000. credit sales of £15,000, cash received of £12,000, discounts allowed £500, and irrecoverable debts of £1,000. So if we just work through that top down, yeah? So opening receivables. So receivables are a asset. So the opening balance on receivables would be a debit balance, yeah? So we've got an opening balance on debit side, £10,000. Credit sales, £15,000. That increases the value of the asset. So that's a debit. So sales going on the debit side. So we've got a total of £25,000 on the debit side. On the credit side, everything that reduces the size of the liability. Sorry, the size of the asset or the liability that the customers have to pay us. So cash received reduces the size of the asset because we've received the cash. So that's £12,000. Discounts. So if we allow a discount, customer owes us less. Yeah. So that's going on the credit side as well, £500 discounts. And then irrecoverable debt. We've written off some debt. Yeah. We're not gonna collect the money. Yeah. It reduces the amount that's owed to us. So add all that little lot together, you've got £13,500 on the credit side. Yeah. So the closing balance is the difference. So £11,500. Yeah. So, and that's all, obviously debit balance is higher. So we've got £11,500, that's the total value of trade receivables. Yeah. So we, as a business, in this particular scenario, are now owed £11,500 from our trade receivables. And that figure should match the list of receivables, by customer. So we should, customer A owes us this, customer B, C, D, E. If we add all them up, that should come back to the same number. You do that as part of your reconciliation process. So the second example then is a Payables Ledger Control Account. So remember, payables, it's the amount of money that we as a business owe to our suppliers. So similar scenario, so we've got opening payables balance of £8,000, credit purchases of £14,000, payments to suppliers of £10,000, some discounts received of £400, and then some returns outwards of £600. So we'll start with, hopefully, the obvious. So we've got an opening payables balance of £8,000. So that means at the start of all of this, we owed £8,000 to our suppliers. Now, that's a liability. So therefore, it needs to appear on the credit side of the Payables Ledger Control Account. So the Payables Ledger Control Account's opening balance would be a credit of £8,000. Credit purchases increase the size of the liability. So that £14,000 in relation to credit purchases also goes on the credit side. So we've now got £22,000 of credits. Debit side is everything that reduces the size of the liability. So payments to suppliers, I don't owe them anymore. We're reducing the size of the liability. Discounts received, so that's the the supplier giving us, the customer, a discount which reduces the amount of the liability. So that's £400, so that's going on the debit side. And then returns outwards, we've sent something back. Yeah. Well, if we sent it back, we don't have a liability for it anymore. Yeah. So £600 worth of returns, that also going on the debit side. So we've got £22,000 worth of credits, £11,000 worth of debits, got overall £11,000 credit balance. So the total value of trade payables, the total liability from our business is £11,000. And again, that should match to the list of individual payables by each supplier. That brings me on nicely to the next point I want to make around reconciling of control accounts. So ideally at the end of each financial period, whether that's weekly, monthly, quarterly, and certainly at the end of every financial year, the Receivables Ledger Control Account balance must equal the total on receivables list, and the Payables Ledger Control Account must equal the total of the payables list. If they don't match, then you've got an error. Now, one key thing that you're probably going to be asked to do in AAT exams is where these things don't balance. So you've got your receivables ledger and you've got all your receivables accounts, your subsidiary ledger, and the two things, the balances on the two things don't match. And you've got to almost work out potentially why or what might have caused them not to match. So possible causes for Receivables Ledger Control Account not matching the balance of all the receivables accounts, and the same for payables, is a transaction might have been posted into the control account but not into the subsidiary ledgers, or vice versa. So it's either in the control account, not in the subsidiary ledger, or it's in the subsidiary ledger, not in the control account. Transposition errors. So you might have transposed it incorrectly. So you might have put £450 in the control account, £540 in the subsidiary ledger, and just transposed the numbers incorrectly. Another reason, discounts or returns could have been omitted. So they're almost in the control account but not in the subsidiary ledgers, or vice versa. Or some errors in casting the totals in either the subsidiary ledger, well, usually the subsidiary ledger. So you've just errors in the totals. Now, control accounts help us to identify these issues hopefully fairly quickly, by allowing you to, obviously, you've got what you think the total value should be, and you've got each individual account, and you can almost use the two to try and work out what the errors are, hopefully fairly quickly. So some tips for AAT exams. I've got 5 key ones. Watch which side of the accounts you're making your entries on. So Receivables Ledger Control Account usually carries debit balances because it's usually value of receivables, money we're going to receive, it's generally a debit balance. And Payables Ledger Control Account, that's a liability, so generally it would have a credit balance. Not to say it can't be the other way around, but it'd be extremely rare for it to be the other way around, and it's not something I'd expect to see in an AAT exam. Make sure you bring the opening balances down correctly, so make sure that they're on the right side of the accounts. Again, typically, Receivables Ledger Control Account opening balance would be a debit, payables would be a credit. Just make sure that you do bring the opening balances down before you start looking at the sort of in-period transactions. Label the transactions in your workings. So certainly draw it out on a bit of paper as part of the exam. And it could be that, it depends on the question, it could be that you get in some marks for various elements of this being correct. So sometimes you don't have to get every entry in the right place. If you get some of the entries in the right place, you'll get some of the marks. So make sure you definitely do it, step by step. Show all the steps in the process. Check your arithmetic. So examiners' reports show that students lose lots of marks on simple addition, subtraction. So make sure that you check your arithmetic. And if you're asked to reconcile something, state the difference clearly and usually state a reason for why there's a difference. As I mentioned, some of the questions almost tell you there's a difference and ask you to suggest a reason why. So again, it's just about understanding why there could be a difference, and what could have caused that. So key things to recap from today then. We've looked at what control accounts are, why they're used, the layout of Receivables Ledger Control Accounts and the Payables Ledger Control Account. Some worked examples for both receivables and payables. How the reconciliation works in practice, and hopefully I've covered some exam tips that will hopefully help you to avoid some of the common mistakes that students make when looking at control accounts. So this episode's going out on Thursday. The next episode's going to go out on Monday. A little challenge before that episode. So a business has the following: opening receivables of £12,000. Credit sales of £18,000. Cash received £15,500. Discounts allowed of £700. And returns inwards of £300. What I'd like you to do: prepare the Receivables Ledger Control Account for the period and state the closing balance and what that represents. So again, if you need to watch the video, you can rewind the video, watch that again if you want to do that challenge. We'll go through the answer to the challenge at the start of episode 9. So that's it then for episode 8 of Debit Credit Done. In episode 9, we're going to look at suspense accounts and error correction. So suspense accounts and error correction, generally that's looking at how we can identify and fix errors within our trial balance. So until then, keep practicing, keep reflecting, and remember, Debit Credit Done.